Hey, welcome back. After falling to the lowest prices in 2 decades and recovering a bit, AT&T still offers a very attractive 6.5% dividend. But following massive investments in the 5G auction, worries about lead cables, a lot of debt, high interest rates and so on, let's see if this really is that attractive. Depending on the CAPEX, AT&T can produce around 18, 20 to even 25 billion or even more. This for a 120 billion market cap is generally, and even relative to Verizon, very cheap. They recently had some cost savings and a couple of spin-offs, including from Warner Media or WBD now, which I like, by the way, you can check out this video. Now, the company is focused more on the telecom services part, which is relatively stable and generally a pretty defensive industry, which is great for a dividend stock. They have 36.5 billion in current assets, which is not enough to cover the current liabilities, but with the normal cash flows, refinancing and stuff that they normally do, they should be fine. The rest of the assets, even without the goodwill, cover all the liabilities, so overall they are okay, actually very similar to Verizon. Now, probably the number one issue people have with this company is the 137 billion in debt. However, it's very important to look into when they have to pay it. We can see upcoming maturities of 7.5, then 5.4, then 10, then 6, 7 billion and so on, and they even have a few maturities in the 90s. Since they make around 20 billion per year, none of these maturities should be an issue, and there is also potential for refinancing if they really need it. The debt generates around 6 to 7 billion per year in interest, but if they keep decreasing it, that should increase the profit and cash flow in the future. The dividend yield is around 6.5%, meaning about 8 billion plus any future increase. This for a 20 billion cash flow is actually very sustainable, and the other 12 billion are more than enough to cover the debt, so this is a very good position to be in. I think some buybacks would have been very good at this price, even if it was 2-3%. So they are overall in a better shape than Verizon, since they have to pay less as a dividend, have less debt and make a similar amount of money. They expect to make around 17 to 18 billion this year, and even that should be enough to cover the dividend and the debt. Now, I talked about the lead cables problem before, and again, the outcome is very unpredictable. There are some recent developments and updates from Verizon and AT&T showing that this is not what the media, whose sources were not really the best in this case, wanted to say. I think this is very likely nothing, but just in case, let's look into the potential impact. Again, it's impossible to predict, but let's assume basically the worst. If they have to pay a total of 50 billion, which would be more than twice the cost of the worst oil spill in history, even that wouldn't be so bad. Obviously, they won't have to pay it all at once, and using that, they can spread it even more. If they spread it over, let's say, a decade, that's 5 billion per year. So, from as much as 25 billion that they can make, discount an average debt repayment of, let's say 7, 5 for interest, 8 for the dividend and 5 from this. And that's 25 billion. Now, sure, the stock would crash, don't underestimate it, but the company wouldn't be in such a bad position even with, again, a fine and a cost that's unimaginable. I don't mean to downplay this, but maybe the market overreacted a bit back then. Now, in a recession, the business itself may not be affected that much since they are pretty defensive and resilient, but the stock can still fall 30, 40, 50% or even more, so there is always potential for a downside. As for a valuation, let's look into 3 scenarios similar to Verizon. If they decrease to 15 billion per year and the market is trading them at 8 times that amount, that's a market cap of 120 billion. Unlike Verizon, that's pretty much the current market cap, so even in this scenario, the downside wouldn't be so bad. Sure, again, in a recession, despite the company itself not doing too badly, the market can overreact and make the price fall 30, 40% or who knows how much. However, in this scenario, the dividend could be in trouble because that's 8 billion plus 7 billion for the debt and 5 for the interest. Now, this is assuming that they don't issue any debt, but if they issue for example 5 billion and pay back 7, that's still a net positive. The issue here is if they need to do some big investments or they have to pay some fine. They'd have to issue a lot of debt, which then increases the interest. Now, is it going to be a fine or a survival investment like C-band that's not going to generate a lot of growth, or is it something that's going to increase the cash flow? Still, not really the worst case possible. In a second scenario, if they normalize around 20 billion and the market is trading them at 10 times that amount, that's a market cap of 200 billion. That's a price of 27.96, so about a 60% profit plus the dividend. In this case, they'd have enough to pay the debt, the dividend, and increase it with a decrease in interest. So around 20 billion would be quite an ideal number for AT&T. And don't forget about the potential to issue debt or shares if they really need it. Now again, a fine or some CAPEX sink would be somewhat of an issue, but they can just issue more debt and still pay back a significant amount. I really don't see this type of company ever having low debt, it's basically part of the business model at this point. But as you can see, that's not necessarily bad. In a good scenario, if there is a bit of growth and the CAPEX normalizes, they can even make 25 billion per year as they did before. It's possible, but kind of optimistic. To be a bit more conservative, let's say that the market is trading them at 10 times that amount, which is a market cap of 250 billion. That's a price of 34.95, meaning a 100 to 110% profit plus the dividends. Now, this would be a relatively high price, but keep in mind that in such a scenario, the company would be in an amazing shape. Again, 20 billion for debt, interest and dividends, meaning that 5 can be used for whatever they want. If they use it to repay the debt, then the interest is decreasing and they have even more money to repay the debt, and this can exponentially improve even in half a decade, and they would be ready for another investing cycle. So if there isn't some fine or obvious upcoming capital sink and they get into this scenario, I think the market can slowly gain some confidence and trade this at a higher price in time. I think that overall this and Verizon, who I talked about recently, are good dividend investments. At the current price, AT&T might be better, but both are very profitable and the debt, despite being so high, is not that big of an issue. I think that once the rates get cut, this and Verizon can easily recover some 50, 60, 80% or even more. I like the cost savings and even the dividend cut from a few years ago, and right now I think the company is in a very good position and the payout ratio is very acceptable. Again, the debt is high even after they reduced it, but no year comes with a significant maturity, so there is a lot of money they can use for whatever they want. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.